Welcome to Shareholder Primacy from Free Float Media, a podcast about activist investing, securities law, and all the ways the financial and legal worlds intersect and collide in real life. Once again, Ann Lipton and I are here. Ann, of course, is a law professor at Tulane in New Orleans who teaches and researches securities and business law. And she, of course, holds up the legal end of our podcast.
And that's Mike Levin, an activist investor who lives and works in Chicago. He covers the financial side of our podcast.
All right, let's get right into it. There's a couple of fun subjects to talk about. There's one more. It's the gift that keeps on giving. More Elon Musk, but this isn't Tesla.
No.
Or SpaceX. This isn't even X. This is Twitter.
Yeah.
Right? Pre-X.
All the way back to Twitter.
Right, all the way back to Twitter, which you wrote, and I commend to anybody who's listening, the paper that you wrote entitled Every Billionaire's a Policy Failure, right? Is that right?
Yes, thank you.
Is just unbelievable. Only paper I've ever read with an abstract that was a meme.
Yeah.
So anyway.
The medium is the message.
Yeah, all right. So, but based on that and a bunch of other stuff, there's another angle on the deal to buy Twitter in 2022 and his disclosures of his investment, his intentions, and his process and all that kind of stuff. So we'll talk about that for a little while. There's some interesting developments there.
Yeah, and we can also talk about what to do when investors knowingly or willingly buy shares in companies with awful corporate governance.
Awful. Yes, I like the adjective. Anyway, let's return to Musk, our old friend. And there was a court decision or some sort of decision or proceeding that just came out in the past few days. What was that all about? Yeah,
I mean, and I gotta say, we keep coming back to Elon Musk, but I have to emphasize it's only because he manages to stumble into so many issues on the frontier of corporate governance and securities law. If you study this, you can't look away. So, this latest case goes back to the Twitter takeover. There's actually still a lot of litigation swirling around it, but in particular, there's this one securities class action. Actually, there are two securities class actions, but there's one in particular that's worth discussing. So you may recall, we all remember, we were all watching, that Elon Musk began the takeover by quietly buying up a lot of Twitter stock. And then suddenly out of nowhere, he revealed that he was a 9% shareholder, which sent the stock price soaring from around $39 per share to $49 per share. And of course, after that, there was the whole business where he was going to join the board and then he wasn't going to join the board.
Went back and forth. It was very entertaining.
Yeah, it was very entertaining.
At the time,
and then he said, I want to buy the whole
look at all the comings and goings. But importantly, right, he was just accumulating Twitter shares in the public market. You could do that. And he then disclosed to everybody that, look, I own 9%. And you and me, I know, we saw that and we said, wait a minute.
Exactly. What was the problem?
How did that happen?
Yeah. Well, the problem was that, as you know, there's a federal statute, Section 13D of the Exchange Act, and it requires that you file disclosure documents once you hit the 5% mark. Yes. And so Elon Musk actually had 10 days after becoming a 5% holder to disclose his stake. The SEC shortened it now. Now it's 5 days. But back then it was 10 days. And he didn't actually file this form until 21 days after he became a 5% holder. So he was 11 days late. And then he didn't even file the right form.
Right. Well, let's consider that for a second.
Yeah.
Most people who accumulate 9% and sort of sit there there's another part of the law that applies, and we've talked about this in the context of 13D and 13G, but ostensibly he would have only, if he was just some sort of normal investor, he would have had to file a G. He would have 13G,
but he wasn't. Right. It turns out that that before he filed the form, Twitter knew he was there. He was already in discussions to join the board.
Right.
He was having tweets about buying the company, whatever.
Yeah, there was lots of evidence that he had his designs on the company, that he was not like BlackRock or State Street or Vanguard buying it for his indexed investment. He had other things in mind.
Right. So when he finally revealed his stake 11 days late, he filed the wrong form. He filed the 13G, which indicates that you're a passive holder. And then like a day later, he filed the correct form.
He corrected his disclosure.
He did within a day. So, but the important thing here is that this 11-day period when he should have disclosed his stake and he didn't, he was also continuing to buy up Twitter shares, which means theoretically, if he'd filed the form earlier, I mean, it's impossible.
Or timely.
Right. If he'd filed the form earlier, then you can imagine that the stock price would have gone up earlier. And he would have, if he had continued to buy Twitter shares, he would have had to pay more. So I've seen different numbers thrown around, but the theory is that he maybe saved anywhere from $150 million to $200 million by delaying this filing by 11 days. And this is illegal. So on January 14th of this year, just before Trump took office, the SEC sued him for not filing the form. This is like 2.5 years after it all happened. The SEC finally filed a complaint about not filing the form.
Right, and this was a standard SEC enforcement action on this problematic and this disclosure error.
Yeah, the SEC files these kinds of things all the time. So, but the real question here is like, why did it take them 2.5 years? It's a simple statute.
Good question.
I mean, if you get 5%, you file the form. We all watched in real time. He didn't file the form. There's no obvious reason why the SEC couldn't have sued earlier. Instead, apparently, it was conducting this long investigation. They deposed Musk, then they decided they wanted to depose him again, and he kept dodging the deposition. It was this whole big thing. And as far as I can tell, the SEC was hoping to collect evidence that would justify more serious charges, because not filing a form, I mean, that's, it's a real thing, but it's penny ante.
Right. And usually the enforcement penalty for bad disclosure is more disclosure.
Yeah. Well, the SEC does these fines in the few $100,000 range, which is nothing for Elon Musk, obviously. But either they couldn't get enough evidence or they didn't have enough time before Trump took office, so they ended up filing a complaint just based on failure to file the form. Nothing more. So that case is still pending. Although it's weird because normally, as I said, the SEC only asks for like a couple $100,000 in fines. But with this complaint against Musk, they want disgorgement. They want him to disgorge the extra money. Yeah.
So their enforcement action is looking for him to pay to somebody $150 or whatever $1 million of extra profits that their economists say he earned by failing to disclose earlier or disclose in a timely way.
And that's really unusual. I mean, I haven't seen that before. I don't know whether it's because they've got, Musk will say it's because they've got it out for him. It could easily be because he refused to cooperate with the investigation. I mean, usually these things settle. So, but that's not the only case, because alongside the SEC case, there is a shareholder class action. It's called Rosella versus Musk, or Oklahoma firefighters pension system versus Musk. But this is a class of investors who sold Twitter stock in these 11 days.
Oh, sold it probably into the run-up.
Exactly. It wasn't a run-up. That was the thing. No one knew he was there. Yeah. So they sold it when it was still trading at around $39 in this 11-day period when he should have disclosed it. And their theory is they sold too cheaply. If they'd known Musk was in the stock, they could have sold for much more.
If they knew it was if they knew it was a takeover target, they would have held onto their shares. Okay.
And so that lawsuit, if it went all the way to trial, that would be a much bigger verdict than the $150 million or $200 million that the SEC is asking for. Because the shareholder action, I mean, theoretically, every single person who sold Twitter stock in this 11-day period could get $10 per share. So this would be a lot.
Right. Well, there was a lot of churn, there's a lot going on, even though it wasn't disclosed.
Well, right.
There was tons of trading happening at that point.
Yeah, but I checked. The stock price didn't move very far. It really did stay. I don't know what the volume was, but definitely it was in this 39-ish, maybe up to 40 range. So we really are looking at around $10 per share that they claim was lost because Musk didn't file. So what's interesting.
So this lawsuit was filed recently?
No, the lawsuit was originally, it's been kicking around for a while. The lawsuit was filed right after, I think in 2022, right after it was clear that he was there.
So they jumped on this.
Yeah, but it's been kicking around for a while, because what's interesting is that it's a complicated claim. And in the middle of the lawsuit, while it was pending, the Supreme Court came out with a decision that actually changed the law. So the plaintiffs had to go back and amend their complaint. And that is what resulted in this recent decision that came out at the end of March, which is what has my attention. So, to understand all this, you have to start with Rule 10b-5, and that's the general prohibition on fraud in connection with securities transactions. And most of the time when you hear about a securities class action, plaintiffs are suing under 10b-5.
10b-5. We heard that all the time. 10b-5.
Exactly. 10b-5. And it has 3 subparts. And if we had visuals, I would put them up, but we don't have visuals because I'm not going to. This is a podcast. This is a podcast. I'm not going to get properly coiffed for visuals. But if we had visuals, I would put up a copy of the rule. So it's awkward to explain. But the critical thing is that it has 3 subparts that prohibit different things. And the main subpart of 10b-5, the one that's usually used in a class action, says it is illegal to, now listen to the wording here, make any untrue statement of material fact or omit to state a material fact necessary to make other statements not misleading. So it's illegal to say something untrue, and it's illegal to say something that's misleading because it might be literally true, but you left out crucial facts that are necessary to understand what's going on. So an example, a misleading statement might be announcing you submitted a new drug application to the FDA, but leaving out the part where the application was missing like really critical information. That would be a misleading statement. It's literally true, but you left out the important part. But so that's this one subpart of 10b-5. It prohibits untrue statements and omitting information necessary to make other statements not misleading. And it has to be intentional. I'll just say that. This is a fraud case and you have to show intent. But that's
you have to show intent, right?
Right. So negligence won't suffice, but we'll leave that aside. Assume it was intentional. But notice false statements or misleading ones. So notice what that leaves out. Dead silence. It doesn't say anything about dead silence. This rule, this subpart of the rule, it prohibits false statements and misleading statements, but it doesn't prohibit dead silence. So the theory here, why, is it's a prohibition on fraud. You have to deceive someone. And the theory here is silence doesn't deceive anyone. I mean, if you imagine I am in a typical arm's length transaction with you between a buyer and seller, neither side has any right to expect the other to volunteer anything. So if I'm buying from you, if I'm buying from you and I ask you a question, if you lie to me, that's fraud. But if I never even ask and you just keep your lips shut, then that's not fraud. It's not
ask and I just don't answer, I forget.
Or if you just don't answer, exactly. Like that's the whole point. The whole point is buyer beware in that situation. That's the theory. Right. And that works if you're in an arm's length transaction. But what if it's not arm's length? So imagine you're dealing with a fiduciary, like an investment advisor. They have an obligation to act in your best interest, so they have an obligation to disclose information. And if they don't, if they remain silent, then you're going to be fooled because you were expecting them to speak up. You were reasonably expecting that your investment advisor...
because of the fiduciary relationship.
Exactly.
That's not arm's length.
It's not arm's length because you know that they have an obligation to tell you information. So you will be deceived if they're silent because you'll take their silence to mean there's nothing to tell. So
but they're right.
Exactly.
Right.
Okay, so which is why the Supreme Court said this exact thing in 1988 in a case called Basic versus Levinson. The court has this famous line: silence, absent a duty to disclose, is not deceptive. But now we have to ask, where does this duty to disclose come from? Definitely fiduciary relationships. If someone's your investment advisor, they have a duty to disclose. But what else creates a duty to disclose? Well, plaintiffs started arguing years ago regulatory obligations. If there's a regulation that says you must disclose XYZ, then it's deceptive not to disclose that information because investors know the regulation and they'll expect you to speak up if there's anything worth saying. And so they'll presume from your silence that there's nothing to say.
Right, because you had this, he had this obligation to disclose in a D, really, but even in a G. This investment, and that was not a fiduciary obligation, it was a regulatory obligation.
It's a regulatory obligation. So the idea is that plaintiffs are, right, and there were lots of cases like this. Even before Musk happened, there were several cases where plaintiffs made this exact argument, sometimes in 13D cases, but sometimes other disclosures, because, I mean, you know, companies file 10Ks, they file 10Qs, and they have all of these items they have to disclose. And plaintiffs would sometimes say, you didn't make a misleading statement. You just left out something that had to be on the form. Like you had to disclose a risk.
And we were kind of expecting this because we're skilled, we're educated consumers of financial filings.
Right, exactly. And if you leave it out, then we assume that means there is nothing to disclose. And so plaintiffs argued, and some courts agreed with them, even if a company didn't actually say something misleading, if they filed a form but left out information they were supposed to disclose, or if they just didn't file a 13D, all of that was the same thing as making a misleading statement. Therefore, you could sue under 10b-5, which brings us back to Musk. So after Musk revealed his stake in April 2022, these Twitter shareholders filed a lawsuit, and this was essentially the argument. Musk's silence in the face of a regulatory obligation to disclose his stake misled the entire market. Now, the thing is that Musk did make one explicitly false statement. the form. When he filed it, he filed a 13G. And he didn't correct that for a day. But that couldn't be the basis of the plaintiff's claim because it didn't affect the price. Like, the price went up because he revealed his presence. But once he was there and he filed the 13G and then he corrected it and filed the 13D, there wasn't much of a market reaction to that. Like, the market reaction...
That's empirically there was no reaction to the
and if there was, they would have...
Right,
exactly. So there was a false statement, this 13G instead of a D, but there's really no evidence that moved the market. So the basis of the claim was Musk had a duty to disclose his stake, and he deceived the market for 11 days.
That's a little unusual, because usually there is, I've seen studies where there is an investor shifting from a G to a D does move
I think
share price.
In this case, I mean, everyone knew Musk, everyone knew about his interest in Twitter, and it was less than 24 hours. I mean, put it all together, and I don't think people just thought of it very differently. So these things take forever to litigate. So Musk filed a motion to dismiss, and the court denied that motion and allowed the case to go forward in late 2023. But then in 2024, the Supreme Court decided a case called Macquarie Infrastructure. In that case, investors alleged that they had been defrauded because Macquarie didn't disclose information it was required to disclose. It filed its annual and quarterly reports, but it left out details of how a regulatory change was going to impact its business, and when the truth came out, the stock price fell. But the Supreme Court rejected the claim. The court just clung to the exact text of this one subpart of 10b-5. The text is specific. It prohibits false statements and omissions that render other statements misleading. It doesn't prohibit silence. So the court said it can't be the basis of a non-disclosure claim. And some of the court's logic, I should mention, is that there are securities laws claims on other parts of the laws that do specifically allow you to sue for leaving out information you were required to disclose. And they have different wording. So like a registration statement, if you buy on a registration statement, there's a specific cause of action about omitted information. And so the court's logic was, well, that's worded differently, and 10b-5 is worded the way it is. It doesn't talk about...
This is what Congress intended, or
well,
whatever.
Actually, the SEC wrote the rule.
The SEC intended, okay.
Exactly. So anyway, so this Macquarie case is obviously very bad for the Twitter plaintiffs, so a little over a month later, they filed a new complaint, and now they had a new argument. As I said, 10b-5 has 3 subparts. So we've only been talking about the one subpart that prohibits false and misleading statements.
Or omission of statements that
omission of statements that are necessary to make other statements not misleading. But there's another subpart, and it prohibits employing any scheme to defraud. Fraudulent schemes. So now the plaintiff said...
Oh, that's pretty broad.
They said it exactly. The plaintiff said this is a fraudulent scheme. It was a scheme to conceal Musk's Twitter purchases so he could keep the stock price low while he built up his position. But here's the thing. There's case law about schemes. And courts have said, you can't just take a statement case and say that's a scheme. If you want to allege a scheme, you need to show there was some kind of conduct that goes beyond speech or lack of speech. The scheme can include speech, but it has to, or non-disclosure.
So there have to be other facts
that there has
about the scheming.
Exactly. Like the scheme has to involve some kind of conduct, something extra. And here's where the plaintiffs got very lucky. Because normally, when you file a securities fraud complaint, you don't have any discovery. You don't have access to internal information. You have to base the complaint on your own investigation and public reporting. You only get access to discovery if you survive a motion to dismiss. Well, at this point, remember, the plaintiffs had survived a motion to dismiss back in 2023.
Oh, they had all this other evidence.
They got it from the SEC's investigation. By the time they filed their second complaint, they had the SEC's evidence that the SEC had turned up from its investigation. And the plaintiffs
on the disclosure stuff.
Right, exactly, on the 13D. And the plaintiffs were able to use that evidence in order to plead something more than failure to file the form. And what the something more was that Musk strategized with his broker to time the trades to make sure that they wouldn't actually move prices.
And there's evidence.
Then there's evidence because
there's like conversations, there's texts, there's emails, there's something.
Exactly. If he's talking to his broker and, oh no, I think the stock's moving. Now, I got to say, that's totally normal. If you buy 9% of a company, of course you're going to time your trades to avoid moving the stock.
Yeah, that's what I talk about all the time with people. Yeah, right.
Exactly. But now the plaintiffs had these detailed allegations about it because of the SEC investigation. And the court accepted that if you combine that with the failure to file a form, that's enough to show a scheme to defraud. Plus, this 13G filing, they couldn't use that as the basis for their false statement claim, but the court accepted that it was part of the scheme to hide his true intentions. So,
because it was a G, not a D.
Because it was a G, not a D.
That combined with the trading discussions and the trading strategy
and the lack of
convinced the court
that there was a scheme. Exactly. So just at the end of March, the court denied the motion to dismiss and the case continues. So there's what's going to happen now. I mean, eventually there'll be a motion for class certification. There might be a motion for summary judgment. And if the plaintiff survives all of that, we may actually get a trial. Now, I mean, most securities cases settle. But we know Musk has kind of made it his thing. He's
averse to that. He doesn't.
Yeah, and he actually took one securities fraud case to trial not long ago about his taking Tesla private at 420.
At 420, yeah, he won.
And he won that. So it wouldn't shock me if he was willing to try this one. And we'll see what happens. But there's theoretically quite a lot of money on the line.
So he's helping redefine the securities law here.
Yes, all the time
about what fraud involves.
Exactly.
Oh, no kidding. Well, as a Tesla shareholder, I'm a Tesla shareholder. Geez, I didn't own Twitter.
Yeah,
I never really Twitter was famously a really kind of a dog of a stock.
Yeah, it never lived up to its potential.
No. And I never really had. I mean, I regretted that once this offer came out.
Yeah.
Well, a lot of people did.
Yeah.
But oh, wow. Okay, so this is going to take a while to sort out, and we'll have to return to this. We'll have to sort of see what happens once it gets certified. We'll start putting word out there. So the lawyers don't need us to do that. Everyone who owns Twitter will find this out. So.
Yeah. Well, who sold Twitter? It's the people who sold in this 11-day period.
Yeah, right. So okay. Well, let's pause. Take a quick break. Talk a little more about what happens when investors eagerly buy shares in companies with bad corp gov here at Shareholder Primacy.
Shareholder Primacy is brought to you by FreeFloatAnalytics.com, the only free database of corporate directors, their influence, and their performance. If you own a stock or retirement plan, go to FreeFloatAnalytics.com and look up which of your elected directors are performing well and which aren't. Use your vote in the alternative democracy and get your data at FreeFloatAnalytics.com. Now, back to the show.
Welcome back to Shareholder Primacy. I'm Ann Lipton here with Mike Levin. So, Mike, what is a certificate of bad corporate governance?
Well, it's this thing I have here. I don't actually own them. I don't have any certificates of bad corporate governance because I only most of the time, invest in companies with good corporate governance, or after I get involved, it becomes
you make them good corporate governance.
That's the goal. But no, there's the certificate of bad corporate governance is a little document that I think people should have or should be required to get when they basically eagerly, as we said, kind of crowd into, get some of the latest IPO that's, from some sort of founder company, which, with dual class stock, or has a bunch of other characteristics. Now, it's of course a little bit of a joke. This certificate doesn't exist, so I think it should. But it does illustrate some truths. And after you and I talked about this a little bit, and I started thinking about this, it became even more relevant in light of what's going on in Delaware, about some of the changes to Delaware statute. So we might amend or update some of what's in the certificate based on what we've experienced in the past little bit there. So it becomes a little more relevant for that reason.
Okay.
Now, you might have some questions about first where this came from. I got to say, it was inspired by our old friend Matt Levine at Bloomberg. So he many years ago wrote about something that he wanted to see, which is a certificate of dumb investment. And
it's his alternative to private and public companies.
Well, and also it would be sort of a substitute or an alternative to the accredited investor system. That instead of showing you have all sorts of net worth and so forth, and that you're a smart investor, just there's this category of kind of bad investments, and he was pretty vague about it. And he listed it as the only ones that don't need it are non-petty stock companies or mutual funds, ETFs with low fees, insured bank accounts. Everything else is considered potentially a dumb investment. And he goes through a whole process, which I'll recap here a little bit, about what it takes once you're interested in one of these. And again, this was inspired because there's a lot of shareholder activists and so forth that complain a lot even to this day, after all we know about like dual class shares, about, bad advance notice bylaws, poison pills, and so forth, we still complain and are sort of surprised. Oh, you mean they're going to use the advance notice bylaw to kind of kick me off the ballot? Oh, how'd that happen? So anyway, and again, it's happened a lot more, lately, because there's all these kind of founder-driven companies, particularly like with dual-class shares,
right,
or super voting rights, or
or increasingly contractual
contractual arrangements, with certain shareholders, and so I was thinking, okay, sort of following the certificate of dumb investment, you should show a certificate of bad corp gov in order to buy shares in certain companies. Okay. Now what kind of companies? Well, there's a lot. Unfortunately, bad corporate governance is a lot more common than good corporate governance. So, clearly classified boards, dual class shares, those are two of the biggies.
This would be like a skull and crossbones.
Yes, exactly. Yes. But there's others, it's not as prevalent as it used to be, but poison pills, there's still plenty of plenty of them out there. Advance notice bylaws are particularly onerous. I think any companies with any kind of advance notice bylaw is bad news, that those really only serve the board's interest and not shareholder interest. But, then there'd be no companies available to you because almost all of them have advance notice bylaws in one way or another. But there's even more like, arcane ones, like, limitations on being able to demand a special shareholder meeting, limitations on ability to solicit by written consent, or even just kind of supermajority voting. There's a lot of things out there that kind of limit shareholder rights, and if we're going to be kind of expansive about this, requiring a certificate of bad corp gov for a lot of these companies, that would be at least interesting. It would get your attention, okay? And again, we can revise this, we can update it, and so forth. So that would be it. Now, the next question becomes, what do we mean by who's in charge of bad? Who sets the rules and issues a certificate? And I was thinking maybe the SEC would be well positioned to do this. They see a lot of this, but they don't see everything. And now that we've sort of seen SB 21 kind of come and go and become law, the Delaware Chancery Court is perfectly positioned, at least for 2/3 of the companies while they're all still there, and we've seen a couple companies, even
so like the companies that now have less liability under Delaware law could have to issue a certificate that says we have no protections.
Well, I think the issue actually is the Chancery.
So the court's like, okay,
what we can do is create like a little division within Chancery Court that that kind of holds, kind of sets the rules and then does the issuing, and they'd be really qualified. Okay, the chancellor and the vice chancellor probably would relish enjoying, really reminding shareholders. I mean, they see a lot of bad corporate governance, so
you signed up for this?
So you could say we warned you, but you still invested. So maybe the chancellors and vice chancellors could do this, and probably reduce the caseload. Because the idea is you lose your right to sue once you invest based on the certificate. Yeah. You can't complain, and complaining would, of course, mean writing a real complaint. So you'd need it probably for like IPOs. Any kind of de-SPAC, there's by definition they're going to be there. Okay,
I'd say a lot of LLCs.
A lot of LLCs, exactly. And so it sort of becomes a little bit like know your customer in banks, where you got to submit the paperwork. So when you open a new account, you got to sort of say, here's the certificates I need, or if you buy shares on the bad corp gov list, and you don't have that certificate, or you're not allowed, or you have to have the certificate, and like a siren goes off on your account. You know how Robinhood, when you buy stock in Robinhood, they kind of shower you with confetti and
I think they
give a little horn.
It was violated the churning rules, but
yeah, exactly. So anyway, and so the process of getting it is pretty straightforward. You fill out this little form, and the form says, you affirm, I want to buy shares in a company with bad corp gov. I understand the company thinks shareholders are a mere nuisance. And the company intends to disenfranchise me completely. I have no right to influence the board in any way. I would almost certainly be better off buying a company with good corporate governance, but I covet this hot stock. So I will never, ever complain about this when the board takes advantage of me. And so I need my certificate. So then what you do, once you've kind of filled out the form, you make an appointment. You go to Wilmington. And the chancellor or you make an appointment with either Chancellor McCormick or Vice Chancellor Lasser or Will or whatever, whoever's available, whoever's working the certificate of bad corporate governance desk that day. They slap you hard across the face and say, "Really?" And then you say, "Yep, really." And then they give you a certificate. So then you can invest in a company.
That would be
with
one
bad
way to
corporate
reduce
governance.
litigation.
And of course, right. So I think the chancellors would probably, I don't know, maybe
they might enjoy
right.
So
the other element of this was quite recently someone suggested replacing the accredited investor rules with an exam.
Yeah.
So instead of showing I have the assets and I have the income and I have this many years of experience, there was a senator. I can't remember.
No, it comes up a lot, actually.
Right. Is there an exam I can take? And Matt Levine said, so loved the idea, he volunteered to take a leave of absence from writing his column because he wanted to write the questions. On the exam. But that was for a certificate of dumb investment. I think the questionnaire for a certificate of bad corp gov is very simple. Yeah. There's only 2 questions. The first question is, what is the state of incorporation? If it's incorporated in either Nevada, if the answer is Nevada or Texas, you still need to get this certificate. You can't finish the exam, and you have to get this certificate of bad corporate governance because it's Texas or Nevada. And maybe a little bit of Delaware.
We might add Delaware to that
list.
Know. Who knows?
Right. The second question is, did you read and understand the bylaws and certificate of incorporation thoroughly and completely? And I can assure you the answer is almost never.
Absolutely.
So that would be the exam. And again, failing the exam and you still need the certificate. So anyway, so that was the idea. And again, there's a truth here, which is that a lot of people I know, a lot of activist investors are, just complain about this stuff. Okay. And so much of that heartache could be avoided, or at least the complaining would be. But the point of Matt's column and the point of my echoing it was, you can invest in this stuff. We just don't want to hear you complain about it. We just don't want to hear you bitch and moan about a dual class share or staggered board because you knew this going in. And right. you value the stock more than you value the corporate governance. So anyway, so that's certificate of bad corporate governance. I don't expect Chancellor McCormick or Vice Chancellor Lasser or Lasser to start adopting this anytime soon. But man, if they want to talk, or anybody there wants to talk about designing this, I'm available. Okay?
All right.
Cool. So that's the certificate of bad corporate governance. Right. I think probably we've kind of covered this enough. Don't you agree?
Sure.
All right. So why don't we move on here, and we can wrap up. This is Shareholder Primacy, hosted by Ann Lipton and me, Mike Levin. I'm an independent activist investor and advisor to investors about their activist situations. Ann is the Michael M. Fleischman Professor in Business Law and Entrepreneurship at Tulane Law School and an affiliate of Tulane's Murphy Institute. You can find me, Mike, at theactivistinvestor.com and Ann at law.tulane.edu. Our podcast is produced and distributed by Free Float Media. Thanks for listening. We will talk again soon.